even though this is recorded, but making notes is really, really important. So when you're talking about risk management 1.0, what you're basically talking about is like, okay, number one thing is how do you calculate lot sizes, right? Even though some people have access to magic keys, some people have like, access to different scripts and websites and not, but like the main thing is how do you actually calculate lot sizes? So this is what we used in the start to calculate lot sizes. So let's say you have risk, right? Dollar risk. Let's say someone has $1,000 account and they say, okay, I want to risk maybe $50. I want to risk $50. And when you calculate your stop loss, and you say, okay, my stop loss is going to be, let's say, 20 pips, right? So what you have to do is you want to measure stop loss in points. So 20 pips is probably going to be 200 points. So 50 divided by 200, 5, 0, 4. So it's going to be around, I'd say like 5 by 20. 5 by 20 is going to be what? 0.4? I think it's going to be 0.4. 5 by 20 is 0.4. My mental math is not that strong. So 5 by 20 is going to be oh, 0.25, 0.25, yeah, my bad. So it's going to be 0.25. So for you to risk $50 on a 20 pip stop loss, you'll be using a 0.25 lot, right? This formula is really, really, really important. Sometimes what happens is that guys have access to different websites where you can input your currency pair and you can input your stop loss and risk and all that stuff. So that takes a lot of time. When you're looking to enter a trade within a minute or 2 minutes, that takes a lot of time. So this formula helps a lot. I have a calculator at my disposal, so I'm really, really easy. It's done. So if you write this formula down, it's going to help you out a lot in determining what your lot size is going to be. And then you can you can move these variables around and calculate what your dollar risk is going to be based on your lot size and stop loss and whatnot. Does this change based on leverage? No. The only thing that changes based on leverage is your risk that you can use at any given time. If you have a lower leverage, you cannot use high risk. If you have a higher leverage, then you can use a lot of risk. So there's a little difference right there. So now risk is basically divided into two parts, right? Number one part is your static risk. Number two part is your dynamic risk, right? The static risk, now most people what they do is they like to use static risk. When you're a new trader, I would recommend you to use static risk. What static risk means is that when you're approaching a trade, you're only approaching the trade from the fact that, okay, I'm only going to be using one position, and one position is just going to be one risk. Let's say if someone wants to use, let's say 1% per trade, or someone wants to use 2% per trade. So what they're going to say is that, okay, I'm going to enter a position, but I'm only going to use 1%, or I'm only going to use 2% on one position, and that's my plan, and that's all what I'm going to do, right? Now, someone who's a little bit advanced or who has some more experience, what they might say is that, okay, hey, you know what I'm going to do? I'm going to use dynamic risk. Now, dynamic risk comes in when you're really breaking down your risk. So what this means is let's say if you're going to say I'm going to use 2% risk, but I'm going to break down that 2% into two 1% positions. Really important. Let's say if someone says, let's say we have Mac here, right? Mac, or we have Brian here. And Brian says, hey, you know what I'm going to do, guys? I'm going to use 3% risk on this one trade. But what I'm going to do is I'm going to break down 3% into three 1% positions. Makes sense? Now you're breaking down your risk. That's what dynamic risk is. You're breaking down the risk based on the fact that, okay, I'm going to open one position. If it goes into profits, or if it goes if it retraces to get a better price, then I'm going to enter another one. And then I'm going to enter another one, bringing the total risk to 3%. But when you're using static risk, you're only using one position, and you're only using a static risk, let's say just 2%, or just 3%, and so on. Formula should be applicable if you change currency to pound and risk. Yes. So basically, when we talk about pips and we talk about normal risk, we're we're just making sure that it's calculated based on the lot sizes. So just to make it very simple for everybody. Perfect. So let's move on to break time is, let's see if